And welcome out to the Tackle Trading Halftime Report. It is June 21st, 2019. We have myself, we have Coach Noah, and Coach Gino today for Friday Fun Day. All the headlines are saying the same thing. Market's pressing new highs. Everybody's wondering if Dow is going to get there. What are you guys looking at today in the market? Noah?
Well, I've been all over the place. You guys still see my screen? That looks like that stopped.
It's popping up right now.
I see your beautiful face.
My beautiful face. It is. No, that's what I'm watching in the mirror. It's like a little narcissism this morning. I look so good. I couldn't stop looking at myself in the mirror. Sorry. I've been watching Tesla just because I've got a set of options that are about to expire on that. So that's what I've been keeping my eyes glued to. It's funny how the trades that are expiring can sometimes draw your attention to them. Other than that, just we've had a good look at the broad market. We've hit a few other candidates this morning in the lounge. Some good looking charts out there. One in particular we were talking about was CME, Chicago Mercantile Exchange, had a pretty chart. But overall, kind of a quiet Friday, for a little bullish bias on most things, but pretty quiet.
Absolutely. Gino, what do you got your eyes on?
Well, I was looking for the follow through from the market hitting all-time high yesterday. And I'm keeping my eye, maybe touch base on that. Day's not over. We opened up this morning with an imbalance in the market. There's actually too much bullishness versus the volume. So I'm waiting for the volume to pick up on the bullish side. And I'm looking at my internals now on that. So the volume was actually negative compared to the advanced decliners. So there was an imbalance. And it balanced itself out. Let me check the time. At 8:10 my time, which is about the first hour and a half into the market, hour 40 minutes. And then it went negative. So not a great follow through. So what I'm going to do is I'm going to look after lunch here. And that's why we have the halftime report. So after the halftime report, I want to see if the volume comes into the market. Because as you know, on a breakout, you should see a follow through. If yesterday was the, touch and go, that's going to be interesting on the market. So all-time highs is interesting. And it's worth noting that I believe gold hit a 6-month high, which is also interesting. So you have the market hitting a new high and a major economic commodity hitting a new high. How do you interpret that?
I don't know. Gold's way up, oil's way up. Markets are way up.
Bitcoin's way up.
Well, it just seems to me like it's a good response to the Fed's, the forecast of a rate cut. Everything that has value except for the dollar's up, right?
I dug a little bit into that after the speech. And in the speech, he actually said, Jerome Powell did, he was like, we're not looking to cut rates at all in 2019. Everyone ignored that. It was like, yeah, but you will. He's like, you're saying college. It's like, you say you're not going to this year. Yeah, but you will. And that's the way everyone took it. Everyone's just like, the headlines even say it, Fed looking to cut rates. It's like, wait, he said no cuts in 2019. Everybody's like, yeah, no, but he is.
Yeah, but so dollar down. Dollar's violating that moving average. I got that 200 period moving average on there. Dollar's pressing down below that. To me, I could draw a trend line up there that looks like it's violating.
Yeah, so that's a big thing is the dollar. That's it, the dollar. That's your culprit.
I am still currently day trading the euro dollar cross pair right now. And I feel un-American, but I'm trading what I see and I'm shorting the dollar.
And I don't know where it's going exactly, but yeah, violating that trend line. The plays on bearish dollar. So when the dollar goes bearish, that justifies everything we're seeing here. Rate cuts, the market likes it. Market's going higher. Money coming out of the dollar. Where is it going into? Everything else. Real quickly, looking at the dollar there, depending on how much lower that could go. Check out gold. And then, what symbol you use? Okay, the gold future. Look at that. Nice move on gold. Breaking out.
It's a nice pop, long upper shadow. Looks like a shooting star up top there. 1,400. We were discussing this morning in the lounge that 1400 to 1430 ballpark is a pretty big ballpark when you back it out.
Look at your weekly chart on that. The weekly chart's impressive.
Yep. So nice breakout above the 1350, 1375 ballpark. And then again, seems that
like the dollar's inverted, right?
Yep. 1430 is a key price point. But other than that, a lot of upward momentum. Gold bug's got to like that, except for the buyers want to wait for a pullback probably.
Yeah.
And finally, Noah, check this out. You want to see an even more impressive chart? Check out Bitcoin futures.
9,960.
Yeah, so we broke the 10,060 mark. Huge move this week.
I wonder if Tim got out of his swing trade. I assume he did because he said he was targeting 10,000.
That's a big move in Bitcoin. I mean, look at the sleeper. I mean, all through the beginning of the year, just sleeping. Doji convention there, right? And then in April, something wakes it up, goes sideways. May shoots up, pulls back, test resistance last week or support. And here it is. It's off to the races, a gap up. I mean, it's just a tear. What's your target on Bitcoin if you could give one?
Oh, man, I have to back out and look at the old weekly there. I think 10,000 was the target. I think it's there. Beyond that, it's 12.
Oh, boy.
So
let me turn my mining machine back on. Let me turn it back on.
Well, yeah, maybe it makes sense to turn the machine back on now that the price is back up. That's pretty interesting. I know I've been seeing a lot more of the the crypto currency traders out there talking a lot. They were so quiet for so long, and it was kind of nice all that peace and quiet. But now they're all talking about it again, like it's the next fest. It's going.
Okay, now are they going to sell this time when it turns around, or no?
No, they're gonna keep buying and holding, and
depends on where they bought originally, right?
Yeah, that's also true.
20,000. So what about this? Big news this week. I don't know if you guys talked about it. Facebook going to use a cryptocurrency.
Yes, we talked about that, but the thing that kind of throws a wrench into it is, the market obviously liked it. They're like, Facebook cryptocurrency, they had a pop on it. Congress stepped in and they were like, hang on, pause. It's like y'all can't, be selling people's data, be throwing out this, be throwing out. It's like we need to take a look at it. What's the intention of it? So I think Congress is going to step in and halt Facebook on that.
Hey, the fact that I found myself agreeing with members of Congress, I think was a sure sign that that's not going to go through.
Yeah.
No, I mean, it's certainly an interesting idea and it's very provocative, but I think that there's going to be some serious questions. And, I have my doubts. I have very strong doubts about that. I can see some sort of dystopian future where Facebook controls everything.
Yeah.
Including the money. So
do we trust Facebook with our data? Do we trust Facebook to not lie to us? Do we trust Facebook to make a reliable currency? No, I do not.
Can you imagine that? Yeah. We're going to go invest in a company that's going to print their own money and have unsecure data where, so
I think this is a great idea.
Buy $20,000 of Facebook currency. What are they calling it? What's the name of it?
Libra. And I'll tell you what I find interesting is, the good old US dollar says in God we trust. Zuck thinks he's God. So it makes perfect sense if you put those together.
Yeah. I didn't put two and two together.
Oh, yeah, that makes
there
sense.
You go.
So
in Zuck we trust.
In Zuck we trust. He's listening. Shh, quiet.
No, we're on YouTube, so Google's listening right now.
We're good. Yeah. So I think Facebook's got a big potential breakout there. 200 is a big fat number. I'm skeptical about that, but I think the momentum in the market making the new highs. A lot of the other FANG stocks are looking pretty good. I mean, check out of all of them, the only one I thought that still had a bearish look to it was the Google down below the 200 period moving average.
On the FANG stocks?
Google.
Yeah, but everything else I think looked relatively bullish on the FANG stock.
Yeah, I'm waiting for Google. I'm waiting for a little bit more confirmation above that moving average, but also I got a 10 and 20 confirmation rollover line I need. Google and what was the other one? The big company, Amazon. Amazon's looking pretty good.
Yeah, Amazon looks like a lot like Facebook. I think a breakout at what do you call that? 1960, 1970 in that ballpark.
And out of the FANG stocks, I did a prediction. I still think that Netflix will be the winner of the year.
Really? I see Netflix as just completely neutral.
Right now, yeah. I'm waiting for a breakout.
Those two lines.
Well, when they announce the next replay, the unedited director's second version of what's that show?
They have a lot of shows.
Yeah. Well, they're going to announce another season of Breaking Bad. It's going to take off. and Breaking Bad, and they're going to do another round of with Sons of Anarchy and Shield. So
I'm gonna just say that I think the best play on Netflix here is a couple condors. That's my thought.
Absolutely.
Which, by the way, halftime crew would not forget. We are going to be doing a DebbieCon later on the show for Friday Fun Day.
Ooh, what do you got there?
CVX came up in the chat there. Frank Martin's just breakout Frank throwing out picks already. Anytime.
All right, Frank. I guess we'll go take a look at your chart. Coming here.
You know, Frank. I feel like it's a tad premature. Like there's a good bit of resistance there, and that's worthy to be on my watch list. But I missed the pop, so today's doji action at resistance. I'll catch you next week on CVX.
Yeah. That is going to be news driven too with the oil and wars thing. So.
Well, let's take a look at crude oil. We've talked about
debit con. Now I'm doing debit cons on oil. As soon as I hear of tension, I do debit cons on oil. Anything that can move big, especially when you have us reneging and say nope. And all you need to listen for is any news of our Navy fleet being moved into the Gulf. And once you hear that, they don't move billions of dollars of military equipment till they prepare. Somebody's going to blow it on the news. So believe it or not, you're not going to find it on American media news that they're trying to brainwash you, but you can look at any Latin American news and Al Jazeera and you'll get the real news. So, once you start seeing American Navy ships moving in secretly, but the news knows, that's when you start throwing on your way out of the money verticals on oil. And they're cheap. They're 50-cent strikes in between. And if you don't know how to do spreads were actually made for commodities, guys. Option spreads are made for commodities, and then it bled over to the option stock market. So, there's a lot of money to make if this thing takes off. So do you think this will get above the resistance area of 65? That's my only question.
Well, that just depends on what kind of news comes out of there. I think it's in a kind of a neutral posture right now. But
all it takes is one of those oil lines to be blown up,
volatility one way or the other. I can see a dramatic move. So, I can see.
But before this, look what happened. Look at the sell-off right before this. Then you got the dollar going down, so that spikes this too. There's a lot of things influencing this. So really, if you put all the math together in the equation with the dollar, the gold, the commodities, this should go up higher even without the news, but the news should make this spike. I can see this actually, if there's more tension in the Middle East, I could see this easily breaking 62.50. Where it goes from there, I don't know. Maybe 67. I'm not sure. But I think we're going to get a little bit of a pullback. Do you see yesterday's action?
Yeah. Nice big pop.
So right after the doji, it broke through that moving average like there's nothing. So coming in the weekend, there might be a lot of news. So here's the thing. Look at when the oil market closes around 11 o'clock my time. Then it goes into digital. Then the market closes over the weekend. When it opens up Sunday, who knows where it could be.
It'll be interesting to see. So debit cons are an interesting concept, interesting strategy. We're going to be talking about those.
Well, yeah. Let's throw one on oil right now. Just hit the trade and watch how cheap. Let's say you don't know how to do a spread. What is the most important rule?
I'll tell you what.
Is risk. Knowing your risk first. Now watch this. This is so easy.
I'm going to stop sharing, Gino, and I want to kick my heels
real
back
quick.
up.
I want to show you how to do it in 2 steps.
All right.
Just hit trade.
Trade, yep.
And plus, let's trade your money. Why would I trade mine?
Well, I've got the simulated account running here.
See the spread where it says single? Let's go 20. Let's go.
Gino, if you said you wanted to trade my money, I actually would not be opposed to it. I'd be like, here, Gino, you can trade my money.
Yeah, that's all I need is another job, right? I'm trying to pass it down to my daughter, and she's struggling with the Greeks at 12 years old, and it's scaring me. So, I'm I'm like, why go to high school? Just learn to trade. Especially if you're going to shop at Brandy Melville every day. You got to teach your kids how to trade. You cannot use weeklies. I do not know why they show weeklies on here unless you're a commodity broker. Thinkorswim will not let you. So August 19, 26 days out, 50-cent strikes. Go ahead and throw your mark on there, Noah. And this is what you do. This is how you learn. This is how I learned. It takes the easiest way to learn spreads. This is so fun. I will spend, what do you spend when you go put gas in the car, Cody? Because you probably spend a little bit more than me.
Less than you, because I live in Utah and you live in California.
Dude, I'm paying $3.70 a gallon.
Actually, I think we're about $3.88 right now.
Oh, see, you're a little bit
you
more.
live in Hawaii, so everything's more expensive.
That's right. Yeah.
So check this out. Half a tank is what? What is a half tank on your car? About $40?
I'm more like 30.
Okay, let's go spend it. Let's do this. Ride your bike this weekend and let's spend a half a tank on this spread. So let's take a $30. Look at the mark and look for.
Well, when I do go to my other job and go to work, it's an hour away, so I'm not going to ride my bike. I'm going to drive.
Just paddle. Up on you're in Hawaii. Just catch the current. On the mark, Noah, go on down to 0.03. 0.03 is
0.03
on the calls, on the call spreads.
On the call side. All right.
Yeah, I'm bullish. At this rate.
0.03. So you're talking like 66.50 by 67.
Yeah, that's $30. So let's click that. It's a half a tank of gas, guys. With commissions, it'd be 35. And there you go. Let's do one contract. Just one contract to do them.
All right, let's go look at this here risk profile.
Oh, you're doing 10 contracts? Okay.
No, I'm going to change it up. I just wanted to go see it on the risk graph here.
And there, yeah,
bring
check
that
this
down to one.
So you can actually get in there for 1 penny, and it's based in not 100 shares per contract, but 1,000. So seriously, guys, $10 you could do these little 50-cent strikes on commodities. Commodity trading is cheap with spreads. It is dirt cheap. That's your risk. So number one, that is your risk. If it does not move, you're going to lose $30 in 21 days or 26 days, not $1 a day. Are you willing to risk $1 a day? And what's your max profit if it goes through the spread, which is only 50-cent spread?
Like a miracle of miracles, you make $470 for your $30 invested.
That is a pretty good return. And so, like I said, 67 is where I think it could possibly go with this news. It seems like a big move, but when oil moves, it's big. It is almost a $10 move, right? But where do you double your money on that? Where do I double a little bit more? Where do I make $50?
About $60, about $60 and 70 some odd cents in that ballpark out there.
So what I like to do is 2 contracts. That way I could make my money back. And that would only be an ATR away, maybe 2 ATRs. Anything wrong with that trade? So that's
I have no problem with the trade other than the fact that time becomes the enemy. It's just got to move quickly and we're good.
And you know what? I'm not even going to put a stop loss on this because $30, honestly, it's not
within your pain.
What are you going to do? Sell it when it gets down to 10?
I'm feeling saucy. I'm feeling like 3 contracts and $90 risk.
Yeah, there you go.
Whoa, calm down. Calm down.
This is what beginners are going to do. They're going to go to work today and go, hey, I learned to trade on tackle trading from some expert. It's only $30. So I'm going to buy 1,000 of these puppies because I got 30,000 in the bank. And you're going to be like, no, that's not.
No, do not do that. No.
If you're going to spend, let's say, check it out. You got to draw a line. Let's say you're going to spend more than $100 total. That'd be 3 contracts, right? I would rather spend a little more for the spread and go closer to the money and do 2 that are like 50. So where's 50 at? If I do 2 contracts, where's 50 at?
2 contracts?
Yeah, well, no, 2 contracts, and I want to do a spread that's closer to the money. So I want to go like.
Okay, so back to August. What kind of delta you want there? Like a point?
No, I don't care about the delta because I want to go through the spread, and I don't even care about the delta, but I want 0.05 on the mark. Where's the
0.05 on the mark, huh?
Yeah, just hit trade. Let me see what
Let's go pick a different layout.
So instead of you finding a whole bunch of contracts, I'd rather get a couple that are going to get better odds. Where's 0.05? We're at 63.50. Oh, wait, excuse me. Right?
You got a 6 and a 5 are your choices.
So 65, $2 closer. Or if you're just going to do one contract, you'd be at 62. See that? One contract is 62, and that's $100 flat. So so think about this. First of all, depending on how much you want to risk. If I do $100, I will put a stop loss on it if it gets down to like 50. But here's the thing. Trades like this, trades like this, it doesn't have to go all the way through the money. It doesn't even have to go it doesn't have to go through the spread. Look at 60, you're doing pretty good. Yeah.
Yeah. Well, I mean, you hit that 200 period moving average and you got 100% return on your money practically. So that's not too shabby. And then you've got
where can you get 100% return on your money in a 1.5 ATR move? That's pretty good.
I was still wondering. I was waiting to see if Cody had any answers there. Like,
yeah, I was trying
legally, Cody,
funny, but nothing came up, and it was like,
where can you double your money legally?
Yeah.
So yeah, that's the thing. This is where you start. Is when you start learning. Okay, I could place this trade with low risk. I'm not going to sit there and analyze oil and politics and stuff because. Honestly, by the time you did that, you could have gone to work and made that risk up in, $50. So you place it and you know the risk, but you pick a direction and then you start fine tuning your skills of, okay, well, let's time the chart a little better. Let's wait for a signal. Let's start going closer to the money and spending $200-$300 on these and getting to know the economics and the signals. So if I'm wrong, Noah, I lose what on that? How much?
Well, if you did, again, depending on number of contracts, if you just did the one contract, $50.
Okay. If I'm right, what's the max I can make?
$450.
So I could be wrong one time, I could be right one time out of 10, right? Did I do the math right? And I break even. So if you're right only one time out of 10, yeah, you're just doing too many of them. Wait for some kind of signal. But if you're right 2 times out of 10, it's great. And if you're like me, you're right 96% of the time and the other 5%.
96, Gino. Man, if you're right 96.
I was following a guy on Twitter and he says, "What's the biggest lie you ever heard about on trading?" I think it was 96%. I just heard it right here.
But you didn't hear the rest. The other 5% doesn't matter.
Yeah, it works.
So my math might be a little up.
Interesting trade.
Really quick, Emily, yes to your question in the chat. So you sell 2. When it gets up to double the money, you sell 1. Now you're at a 0 risk. So you still own 1 contract, but you've already made your money back. So it's risk-free.
You got it.
Now you're at a risk-free trade with the possibility of making $450 in the next 30 days.
Right on.
And
that's never done futures. Number one, this gets your feet wet. It's like, well, wait a minute. What are these symbols? What are these strikes? Why is it 1,000? All that stuff will pan out. The whole point is this: place the trade in paper money, know your risk. Once you're comfortable with the risk, everything unfolds faster, period. That's how I learned futures on my own. Is I already knew how to do the risk. I already knew how to trade, knew how to read the charts. I just had to figure out the risk. And you don't want to go into expiration. You want to get out, when there says 1 or 2 days left and be done. So that's it, really. I mean, if you already know how to spread trade, oil is it is the biggest commodity traded, by the way, with gold, which we already talked about. And then a strong third, Java. So yeah.
Wow. I'm sitting here on my own screen and, went ahead and threw on 2 contracts. They filled pretty quickly there.
Well, this virtual account I'm in was not authorized.
It's huge. Well, the market's open. Now it is digital and it is open outcry. It is open outcry and it is.
That was crazy how fast that thing filled. I feel like I got robbed. I should have asked
for a penny lower.
I should have paid less.
Don't you hate that?
Now I'm upset now.
Especially when you're on delayed data and you're in Hawaii. They're going to get real time out there someday.
No, it's definitely real time. We have trans-Pacific cables that run from Japan and everywhere that all meet here in Hawaii. So
no wonder my line snag when I go sea fishing.
So there's a good question in the chat there. Do they require a certain amount of capital for your account to qualify for futures?
Yeah. First of all, most brokers want a margin account. You have to sign a disclaimer of the risk disclosure of futures. And in paper money, no, nothing. Anybody could do it. You have to turn it on. You have to go to support chat and toss and say, please activate my futures options, because it'll reject your trade.
Yep.
And that takes literally 10 seconds to do. Just hit the support chat, please activate, and say, I'm practicing futures trading. And while you're in there, say Forex, real time. So they activate the real time on your paper money. They'll do it right away. Say you're practicing and you're part of tackle trading. They know who we are. And then in the real account, most brokers, and this is amazing because I've been around too long, is futures trading, especially commodities, your minimums were like 100 grand in your account. And you had to be approved. Now, when Thinkorswim got it, they brought down the minimums to 25,000, I believe it was, and then 10,000. And I think now certain futures, you only have to have 5,000 in your account. So what's nice about this is it scares you. Wait a minute, I have to have 10,000? That's risky. No, if you're only doing vertical spreads, it's whatever you pay. So it was what? I mean, there's some on there, Noah, for $10 for a penny. Look, where's a penny? Where's a penny at on that? One penny's $10 is 1,000 contracts, 1,000 shares. One penny, where's the mark?
50.
Actually, one above that, 69.50.
Yeah.
So me personally, I like 1 point spreads. I don't like the 50 cents, but I'm just trying to show you how cheap you can do it. That's $10 risk plus your commissions at $2.50, so $12.50. That's what sucks about futures. The commissions are only about $2.50 on toss to $3. If you have a futures broker like Interactive or something like that, you'll pay 70 cents to $1 per contract. But there you go. I mean, $10 is your risk. It's hard to find any option spread that cheap anywhere. So, and it's all because of look how tight the spreads are. They're 50 cents.
Yeah, there's no time to cam futures contracts, but there certainly is on the options on futures.
Yeah, there is option. And what's weird about it, it's not real linear or you'll see sometimes Noah, you'll see the volatility on the options, the Vega jump around more based on the news. It's not controlled like the Black Scholes on the options on stock. So with the news tension out there, you can see it jump up sometimes. Like you'll see like on the puts, it'll really drop down versus the calls. Because think about this, commodity traders, futures traders, it takes more to be approved in your account. It takes more experience. You actually have a batch of more experienced traders trading futures and commodities. They're out of the stock arena. It's kind of like when you go play blackjack, you want to sit at a table with pros, not beginners. Why? Because the beginners throw the game off, right?
Oh my God. If you sit behind someone who does a dumb split.
Right. That's kind of like the stock market versus the commodities market. The commodities market, bigger money, more corporate money. And what's nice about it is they have to buy these corporations that they have to buy. It's not like, oh, let's just do it for capital gains and investment. No, they have to buy it for business. You know, the oil market. So you're dealing with, war tension, all these things, the dollar. It's so sensitive to real life economics versus emotions. Stocks, emotions. Stocks is emotion. If you think about it, it's just paper, right? Commodities is not paper. It's, you can touch it, feel it, see it, use it, it's a big difference. So honestly, I love trading commodities. They don't go bankrupt. No earnings. No earnings or surprises. Is it manipulated? Yeah. By big corporations and governments, but it is something.
And drone strikes and, things like that.
And it's international. It's big time international, but it spreads. And that's where the spreads and options started. That's where it started, right here in the commodities market. So, but no, think about it. You could go to this weekend going, hey, I learned how to do something really low risk on something that I know what it is. Like I can explain canopy growth to somebody or Six Flags or Facebook. And then all of a sudden, think about all the motions. Well, Zuckerberg, and all these motions kick the stock, right? When you talk about oil, you don't have to tell anybody what oil is. They drive by gas stations every day. They put it in their car. They spend a lot of money on it. And they go, oh, I can actually trade something I know. You know, as soon as you get your license, you know what oil is. And you're watching the prices all the time and you're watching the news. So it's less emotional trading. So it's very interesting. I enjoy it. I enjoy it. And then, you know, the future side of it is how you trade it. So you got it right there. So yeah, if you want to try something low risk, real quickly, Noah, while we're talking about it, you've got the spread on there.
Yeah.
Watch this. Here's the debitcon and one more step. Let's go to the put side and do one for the same price, 30 cents.
All right. Let me get that back on there. 30 cents.
And, yeah, the same price as that one, just to make it pretty. So it's the same distance.
So same distance. So that would put us, what were we at strike wise? We were at, we were at the original one, 30 cents.
Yeah, it was like 66. Yeah, there you go.
Okay.
So when you do the 30 cents, it might be the same distance, pretty close. It all depends on their outlook.
So in ballpark around the same ask of, or the bid ask mark. Let me throw that mark back up there. Boom.
Yeah, you're going to be about 0.03 on the mark.
0.03. Yeah. So that puts you about 48.50 by 48.
There you go. Perfect. Perfect. And if you analyze that with one contract, you have what we call a debit spread on each side, or debit condor. It's for somebody who doesn't like to guess direction. And you got more contracts on one.
I do. I got two. And
that's fine. You could hedge one off like that. There you go. That's your debit condor. If it goes up, you make money. If it goes down, you make money. It just has to go up or down big. Interesting play, huh?
Yeah. Not too bad. Fixed risk. You just got to pick, a little bit easier to make the money, I think, if you pick the direction, but if you're doing the debit con.
It has to move a little bit farther to get double your money too.
Yeah. Yeah.
So that is playing commodities. And, it just, honestly, it's kind of cool in the marketplace or on campus just saying, oh, yeah, I got debit con on oil futures. You're like, wow, that guy's big trader.
People are going to be like, wow, what is he talking about?
Yeah, that's what we were going to say. I don't even know what that means.
yeah, I'm long the futures on oil commod. I'm on the oil commods. That's a good way to start happy hour. Then everybody's going to change the subject on you.
You start happy hour that way, they'll try to make you buy.
Yeah. Here's money bags here. So that's low risk trading. And I'm not even going to go into it, but you can do the same kind of spreads on gold. So
cool. Why don't we jump over to Tesla? Because I believe that was the one that we promised our students we would do a debitcon on.
Let's do a debitcon.
And let's see how they look on Tesla, since oil, spreads can go a little bit further out. They're quicker to fill just because the market's so much bigger. So just want to take a look at what it would look like on a stock play, especially one as volatile as Tesla.
And I want to congratulate Cody for, once you see what the risk is, you're confident, Cody, with the risk. Look how fast you placed that trade.
Oh, yeah.
That's what you do.
Yeah. It's same thing with, various butterflies or spreads or different things. Like I just do it.
If you didn't place the trade, it's because, you're brand new. You're unsure of what you're doing. You're not sure what a spread is. But if you know what a spread is and you know how to place an order, do a self-analysis check, because if you didn't place that in paper money, you're either feel like you need to learn more before you do it, which means you're overanalyzing. You're not confident with the risk, which means that carries over. You're probably not confident with the risk you're using in a stock market either. So psychology of it is, once you are confident with the risk, then you create consistency and then you see cash flow. That's the 3 C's.
Yes.
I did a video of it yesterday.
What was the 3 C's again? Hold on, I got to write these down. They were what?
Yep. That was a Gino gem. Write these down in the chat, guys. Write them down.
Oh, can you remember, what did I just say? We rewind. Yeah.
It's all about something about cash flow.
Yeah. All you heard was cash flow. That was it. So you placed the trade. So once your confidence really comes from being comfortable with risk. That's what confidence in trading is when you're confident and comfortable with risk. So confidence is everything. That's the goal of education, is being confident.
Oh, absolutely. I mean,
so once you're
seriously, like the ability to pull the trigger on a trade, I think ultimately comes down to confidence, because people go and place trades without the confidence, but they're obviously nervous and they can do some dumb things. They can make some really big mistakes.
Yeah, right. Think about it. You're afraid of the risk. I don't know why this example popped up, but I was afraid to say hi to my wife when I first saw her. I was afraid to talk to her. I wasn't confident. Now I just yell at her. I'm so confident now. There's no risk.
I think you got at least 50% risk, Gino.
I'm gonna get fired.
You're not.
I gotta be careful, man. She's probably in the other room loading the gun right now. So, but
I didn't know you could have those in California.
Confidence in everything, not just trading. Once you're confident, consistency is next. Why consistency? Because there's too many traders out there that go, oh no, it's just a hobby. It's a part-time business. And why is it that? Because they can't create consistency. And what that means is this: consistency. I don't know if you know anybody that's in a band or an actor. I'm in Hollywood, so I see both. I've had roommates that were actors and friends. And of course, me, I was big in Hollywood, no, I'm joking. Here's the thing is it's fun to win on a trade and get a big payday here and there. But if it's not consistent, you can't budget it. If you can't budget it, you can't make a living. So consistency, it's better to know that you're going to make $100 a day than $5,000 here and there. Because if you're making $100 a day, consistency means you've got a system. When you're at random, like somebody who's in a band, oh, I got a gig, I'm going to get paid. Or, oh, I got an audition, I might get a payday. Or, one of those like artist type living. Yeah, it might be a big payday, but once you're paid, you don't know when the next paycheck's coming.
Yeah.
You know what I mean? It's big. That's if you're trading like that, where, oh my God, I nailed that trade. I was awesome. Don't start planning on retiring it until you can do it consistently. Now, consistency doesn't mean every time. Let me repeat that. Consistency does not mean every time. Consistency is when you say, I can do that 6 out of 10 trades.
Well,
maybe 5.
If you can consistently manage the risk, that's the kind of consistency I think you need to see before you can even consider, trying to hit the profit targets. Because if you can find some consistency with profits, but it depends on what the risk is. Like, honestly, like if people are overexposing their risk, trying to cover that monthly nut, expense wise, I think that's one of the challenges people run into is they start seeing that they can make the money. They have the strategies to make the money. When they're right, they make the money. But if they're wrong, how much of their account did they risk
And that's so true. And I'll give you a great example. When people learn spreads like condors and credit spreads, they look at the deltas and they go, hey, you know what? I'm selling of a 10 delta. I have a 90% odds. They assume that's consistent. I'm going to win at least 90% of the time. They do that condor 7-8 months in a row, maybe even 4. And they think 3 or 4 times in a month. 4 months seems like a long time of trading. You go, I won every time. That's consistent. Well, it's 4 months, only did 4 trades. So you really didn't get a really good grouping.
Well, it's also understanding the difference between probability of touch versus probability of the close.
Right.
And that's also something that you think that, the 9% of being right. Well, not necessarily, because it's.
And that's why I said yesterday on my video on social media, when I do my mindset video, is I do a strategy about 40 to 50 times at least on different stocks before I call it consistent. And actually, I even fine tune it when I get down like 100 trades. If you do a condor every month, it would take you 40 months to do that. So here's the thing. People won't do it. They're just going to base it off, hey, I won 3 times in a row. It was easy. It expired out of the money. Oh my God, it's the end all be all strategy. Therefore, it's consistent. I'm going to quit my job. Around the 8th or 9th month, they lose. And it's 9-to-1 risk to reward. They lose it all and give it all back and more. Then they start going, oh, so this is what it's like to lose. Shoot, I should have tested it more. And the whole world crashes in on them on that strategy and they hate it. It's because you didn't back test enough. And nobody wants to spend the time to get consistency. So, you nail it a few times. You think you're a king of that strategy. So you really got to back test it and be really solidly confident. Like, oh, okay, I've done it. I've done the research. I see too many people that go out there and I've done this. And I go, oh, how long have you done that strategy? 3 times, 3 months. Well, they say 3 months, you think, 90 days. But on a Condor or some of these spreads, you're like, well, how many times did you do the actual trade? How many different trades? Oh, 3. You're like, okay, so I'm going to go risk my hard-earned money on something you tested 3 times. Now, there's a few people on the opposite end of the spectrum that will paper trade forever. They've been doing it 3 years, and they're engineers. And you're like,
hey, no stereotypes here.
And you're like, well, wait a minute, 3 years, you've tested this thing enough. And they're like,
they need empirical evidence, Gino.
Twice. And you're like, okay, you lost twice, and it's not enough to build your confidence. Nope, they have to be perfect. So, where are you on that? You know what I mean?
Where are you on the spectrum?
Yeah, that's the main thing, right?
The engineer spectrum, is that what that's called?
Well, yeah, the engineer, they overanalyze. Noah, you're a good example. I mean, you designed software, that trading software, and it had to be back tested because honestly, when you're using a software and algorithm, how solid is it? I mean, it's only as good as the guy programmed it, right?
Yeah.
So some of those I worry about. It's like, okay.
Well, and a lot of the folks that I would work with that would do the actual programming, I'd come up with the concepts and theories, but I didn't do the programming myself. And you'd end up finding the flaws. Like you'd end up finding where the algorithm breaks down. All too common. But yeah, I mean, it's easy to overanalyze stuff. Way easy to overanalyze stuff. Too much time before you build that confidence.
So the way that I decided to jump in was I'm very analytical, but I'm also not hesitant. So I basically jumped and then started trying to build the plane as I'm falling.
That's how you do it on paper money if you're brand new. That's how you do it.
Well, I think there's something to be said for getting your feet wet with live money. You got to get in there and take the small risks. And that's where I think the trades with fixed risk profiles can be a great place for people to start, because it's, what's the actual risk here? Like that, putting that futures trade on the oil contracts, with the max risk of $30, you don't have to be good. You don't have, you got fixed risk. That's the kind of trade I think you can figure out and test with, with when you got the right reward to risk ratios on that. Flip that over to where you're selling the condors and you got the inverse reward to risk ratio. That's where you need to really test your mettle.
Let's go ahead and build this one out here. See what this looks like. That way we can show it on stock for those who don't have the ability to do it on a futures contract.
Right.
All right. You want to build this one out, Gino?
Sure. Or you want me to walk you through it?
Okay. You want to just walk me through it?
Yeah, I can walk you through it. It's pretty easy. The hardest thing is if you're not familiar with spreads, max risk and reward. We're talking about verticals is all we're doing here, the debit condor. Debit condor is something I started using because I was trying to protect my iron condor. And what it was is I had an iron condor on a stock that moves big on earnings. And I was like, it's kind of showing a loss. I didn't want to get out. And I knew after earnings, the volatility was going to drop and my condor would be profitable if it didn't gap huge. So to protect it from the directional move, I said, what if I buy a short-term directional, the exact opposite, just to get me through a couple days? And so I said, well, let me go buy a couple of small verticals. What is a good risk reward? And it ended up being a good strategy. And I now use it all the dang time. So all I do is it's a short-term play, just like the one we did in oil. I'm looking for, and why are these short-term? I don't want to get into it, Noah, but it's gamma scalping. We're not going to go with deltas. We're going to go with, when you're getting close to expiration, you're playing that slant on your on your risk reward. So basically, I like to go 30 days or less, and me personally, 3 weeks or less. So let's jump into, let's look at the 21-day versus 28 real quickly. I want to show you the example, a difference between weeklies and the natural, I call it, options. There's a huge difference. And one of the main differences is this. You're going to have a lot more open interest on the 3-week options. Those are the originals, the naturals, right? The weeklies, the ones in between, they haven't been around as long. They've only been issued for maybe a month or two. Now Tesla, they have a lot of weeklies, but maybe I think it's like 6 weeks of weeklies. Therefore, the open interest is not going to be as big. So don't let that scare you, because they won't put weeklies on a stock unless it is liquid and they feel that there's enough liquidity for the weeklies. So most stocks that have weeklies are good to go, just as a note. Most of them, not all of them. And what I want on there is I just want the mark. I want the mark, and that's about it. That's what I'm going to really look at.
Just the mark, eh?
Yeah, just the mark. You can put the delta on there, but we're not. That's today's delta based on the options. We're actually playing the expiration delta, which is 1-to-1, because we want it to go through the spread. And there you go, the gamma, perfect. So on the mark is what you would pay if you got a good fill. You want to do a limit order and you want to get filled. When you hit vertical on there, it defaults to the tightest spread. So right away, what you want to do is you want to look at the spread and what is the difference between them? It looks like
250.
250. And you're on a weekly, right?
Yep.
It's very important you know the distance between the spreads, because some of these stocks, if you go farther out of the money, they'll expand to $5 between them, $10 between them. And it could fool you, you know. So it defaults to the tightest. So that's the tightest spread you can do is 250, which is great on $220 stock. Now, real quickly, go to 28 days out, the 3-week options. They'll probably be a little different because they've been out long. There you go. See, they're
$5 strikes.
So there's a difference here. Now, why? Because 250 versus 5 means you're going to have twice the cost on that spread because it's wider, right? So if you like doing 5-point spreads, great. But if you want a tighter spread, you're going to have to look at the weeklies. Now, some weeklies will be 1 point. And sometimes on the naturals, they'll be 10 points. It depends on the stock you're looking at. So what I wanted to point out is you get comfortable looking at different strikes. Find the spread you want. Sometimes that people just jump to the natural 3-week one and they don't realize they can actually get a cheaper spread, because a 2.5-point spread will be half the cost of a 5-point spread. That's the way it is. So what you do is this, you look at the 2.5 points. What's the max reward you can make on 2.5 points? You times that by 100.
250.
So $250. The simple math is this. Well, it's not simple if you're not good at math. Use a calculator. You take 250.
Hold on. Let me grab my calculator.
250.
Okay, go on.
Run it through the Black Scholes. No, I'm joking. You take the 250 and you times it by 20%. 1/5 of 250 is what? $50.
$50, and you go find the mark for $50.
You got it. You find a mark for $50. So you got two choices there. Now, this is the hardest part, is which one do you want? Do you want the one that's 54 cents, or do you want the one that's 47? I personally would go for the 54 and ask for 50.
Well, you could pull that off.
There you go. So there it is. That's your risk reward. Now, max risk is $50. So if we were doing a 5-point spread, 1/5 of 500 would be $100. So $50. And so basically it doesn't matter the price of the stock. It could be Amazon. It could be the S&P. If it's a 250 spread, you only pay $50, period. Therefore, think about this. You can get a 250 spread on, I don't know, Intel in the 40s or 50s, or Microsoft, right? Or like something in the 40 or 50s. Here's the thing. I don't want to spend $50 on a stock that's less than 100 or cheap. Why? I want a mover. I want something with a big ATR. I want something with like Tesla. If you're going to spend $50, that's your risk on a stock. Get one that moves, right? So these are great for stocks that are over $200. Stocks that have an ATR of 250 or more. So where's that at? Where's that spread at?
Well, let's see. That is 242.50 by 245, 50-cent debit.
Okay, so how far to the money is that? Is it possible?
Well, let's see here. These expire on the 12th. So let's go set that out at the 12th there. Light gray area. Yeah, it's possible.
Yeah, that's pretty good. It's inside the gray area.
I mean, that's just out here, but below this old support zone back here.
Okay. And the simple thing is, no, we're just going to go on the put side and do the exact same thing.
Yep.
It'll be almost the same distance because they priced the puts a little pricier, so it'll be a little farther. But that's okay because when it drops fast.
So we got a choice of 58 versus 50 cents.
Here's the deal. Since it drops faster, I'd probably go 195, but you know what? It's not bad to go, because if you place it all at one trade, you get a big wide bid ask. You might get to 197.50 there.
Yeah.
Try for the 197.50 for like 55 cents. You know what I mean?
Patience, see how long it takes you to get filled.
Yeah. And there's your Debicon. So what? Now you spent 20% on the other side, 20% on the other side. Your max risk is 40% to make 60 or 150% return. And it's real easy to double your money. What you want to make sure is to check a good one, Noah, is unclick one of the spreads. Pick one to unclick. Here's your check, your litmus test. It's a decent one is if the stock moves two ATRs. If it moves two ATRs, will you double your money?
Yep, you will.
Then that's a good one. If it moves two ATRs. Now, what's an ATR in Tesla?
$10.
Oh, geez. Yeah. So, yeah, it's going to put you right at the long leg there.
Both of them work. Both of them
At
will
the
give
long
you...
leg, it's definitely a good trade because that's where all the Greeks spike when you're at the...
Yeah. So 1025. So that means from the current price, 219, that would put you up at 240 ballpark.
Mm-hmm.
So, on the call side, on the put side, it'd put you down at 200. So down at 200, you're making 50, 55 bucks. Again, that's assuming it moved quickly. And on the call side, 50, 60 bucks. Same story.
Yeah. And here's kind of what you get jiggy with is, again, I always do 2 contracts.
Get jiggy with.
Pick a side. Start picking a side, right? Pick a side and do one extra contract, broken wing it. You know what I mean? So there's your pretty debit condor. And that will protect your iron condor in the short term. So let's say there's earnings the next couple of days on this stock. You throw this puppy on, you'll make your max reward before it gets your iron condors way out of the money, right? This will protect it temporarily. And then after earnings, get out of this thing. If it's profitable, you made money. If not, sell it back. It's temporary protection. It's a short-term condor debit protecting a long-term iron. And I have people who have been doing iron condors for years going, oh my God, there's the holy grail of protecting this thing. It's a temporary thing. And believe it or not, Noah, the time decay on this one isn't that bad compared to some of these iron condors out there. Isn't bad. It actually decays slower.
Yeah,
because
about
once these options get to like a nickel or a dime, they don't move. You notice that on spreads that are out of the money when they get down to like 5 or 10 cents, or actually 10 or 15, they never see a nickel. They take forever that last week. So if it's still in the middle there the last week, that means it's not decaying, and your iron condor that's out of the money is. That's longer term. So I don't want to get into the advanced stuff of it because I'm giving away too many secrets, but that puppy right there, you don't want to max out. You're doing good if you nail 2 out of 3 of them. So back testing, if you're nailing 50% of them, now that's not all the way through the spread, by the way. That's to where you think you made a good enough money and you take some, right? Back testing it, you don't judge it on, did I make max profit or did I lose? You judge it on, did I make max profit? Could I have gotten out with profit? And then did I lose? So I always take one contract off after 2 ATR move where you're kind of profitable. And it's those base hits that are everything. And you nail 1 with max profit. That's great. Now, is this a good play before earnings?
Well, that's a great question. I was wondering a little bit about the Vega's negative. So the increase in Vega might hurt you a little bit, but it's very small Vega. So it probably doesn't kill you.
Yeah. So watch what happens if volatility goes up like 3%.
Go add a little volatility plus 3%.
Watch the purple line. So it lowers the risk big time. See that? Now look at where it is. So you're not break even anymore. You actually.
Oh yeah, your Vega's actually right there. And then hold on, I got to reorder my price slices there. Let me go reorder those. So yeah, middle price slice, 219, your Vega's positive.
Yeah. So volatility goes up just like a strangle, because it is a strangle basically. Look what happens to your risk reward up there. Your break even disappears. You're actually profitable on a volatile. So here's the deal, earnings is coming up tonight and you're looking at this right here, take some off the table because you're showing profit. After earnings, you show like a 10% drop in Vega. That will hurt you. You need it to move. So it's the same rules as, let's say, a straddle or strangle. Same exact rules. But okay, now check this out. Using that real quickly, Noah, if you were to use basic strangle rules on this, watch how expensive it would be. So what's this one? How much does this one cost? $100?
Yep.
What would a strangle cost on Tesla? And then volatility is not even high right now. I mean, a strangle would be, well, just go look at the at the money options.
For the same expiration date?
Yeah, same expiration date in single.
What strikes?
Oh God, just to pick the at the money ones, 2,500 right there.
$2,500.
Yeah. So it is 25 times cheaper than a strangle. But now check this out. Throw on one, pick a strangle, pick one that's one strike out of the money, one strike on both sides. So that one right there.
Okay.
And look at the break evens on the strangle. The break evens on the strangle on expiration are where?
Way out.
Yeah.
Yeah, that's quite a big move on either side.
So because it's got to move $25
yeah,
each way.
245.
That's a 50-point window. That's huge, right?
Yeah.
That's your break even. That's not even profit. Versus looking at the debit con, it's max profit.
There you go. That's interesting. Max profit, the same ballpark.
Wow, that's really cool.
Max profit versus break even. I'll take the max profit. And 25. Then here's the thing: the risk 25 times less. So that kind of motivates you to learn spreads right there. So I didn't want to get into advanced options and use my calculator and stuff, but you know what? No, if it saves you 25 times the risk, that helps you with confidence, right? Now the consistency on this one is if you're nailing it 60% of the time, you're doing good because you need to move. You need to move on these, but it allows you to play stocks that move like Tesla. Let me think. Tesla, all the FANG stocks, right? Netflix, Google, Facebook. You know what? Can I tell you what? There was a cheap one I was looking at for a cheap vertical. What was that? What was that? Amazon. Now, something like Canopy Growth, CGC, I would just use a cheap vertical out of the money because the volatility is already high. And see that? They missed earnings big. And if that, by the way, if that breaks down, that'll be on the scouting report this weekend for the shorts.
That's a good breakdown setup.
Yeah, they missed earnings last night. Look at that.
Earnings? Oh, yeah.
And bad outlook, too.
Fun watch. Sweet.
So anyway, that is the debit condor. What are your thoughts, Cody?
Oh, no, I'm sitting here soaking in the knowledge I just got from the comparison of those two.
Yeah, I hate straddles and
I
strangles.
didn't have a calculator handy though, so I'm gonna have to.
So Lane asked, why would somebody do the other strategy? They lack of knowledge.
That's it. You don't know how.
If you didn't know how to do the other con, the debit con.
You don't know what you don't know, and
we have the rules on site.
So there's the four levels of learning something. You start with
unconscious incompetence.
Exactly.
Yeah.
You're unconsciously incompetent. You don't even know what you don't know. Right. Then you become consciously incompetent. So you know what you don't know. Then you become consciously competent, which means you really have to work hard to make it happen, but you can do it. And then unconscious competence is where you're just doing it. You're throwing these spreads on, you know they make sense, you can just see it, it works. That's the riding the bike side, or driving the car. think about it. You just do it.
And that's what's beautiful is when, and here's the two sides of it. It's beautiful when you have boring consistency. Why? That means, like you just said, you just do it. Oh, I do about, my budget is 5 debit cons a week and 2 condors. And here's my watch list. And I wait for my trigger and I try to pull off this many. Then I call it a day. When it gets that consistent, it's almost boring. It's turnkey. And that's what you actually want.
Well, then you take, $1,000 and go to casino and for your fun, let your account keep making money. Right. And go gamble at casino. Don't gamble in your trade account.
And that's what I did is I got these systems, from guys like Noah and all the different instructors and all the different classes over the last 20 years. And we compare strategies and stuff. And then what you do is when you start seeing consistency with it, it works. You start tweaking it a little bit, add your little spin on it to see if it works. And you come up with your own strategy and system. And that's the fun part, is if you have the patience to do that. We have a friend named Jeff Crystal. He's gone down the rabbit hole on that. And he's created so many strategies that you'd have to lose nights of sleep to keep up with him. And that's what motivates him. It's not even the trade.
I have lost
Crystal is a machine.
Yeah, I have lost nights of sleep trying to keep up with him.
That's what motivates him, though. He's bored with the consistency of just trading and scalping and doing this, to where he's like, let's pioneer this and go into a different realm. And is there a lot of failures in doing that? Yeah. But he does it enough to where he has his business income, and then he has what we call the hobby income. What motivates you? So Cody, one of the things is, like you said, let's go to Vegas. There's times where you're like, you know what? If I made 10,000, I might put 500 of it into a risky stock like Canopy Growth, or somebody who's at an all-time low, or an extra Bitcoin or something. You know what I mean?
Exactly.
So that, if that motivates you, the risky.
But that's also where speculation could come in and be a part of your account. Is finally, sorry, I just had something fill. But you can have that speculation part of your account, that 5 to 10% of your account that you're working on some of these trades that are higher reward, or higher risk, higher reward. But that only needs to be a small part of your account where you're doing those speculative types trades.
Yeah, that's true.
And I like you kind of joked in the very beginning, but it's absolutely true. Someone will see a trade like this, or any of the trades we set up, the ones on oil, $30. They're like, well, let me go put 10 of them on. Let me go put 30 of them on. It's like, whoa. Yes, if you put 30 on, you're looking at 450 times 30 is going to be what you can make on that trade. But your risk and what the percentage of your portfolio that you're now risking is way out of proportion.
Yeah, that's the number one mistake. Number one mistake is assuming options are cheap so you can buy a ton of them. That's what people do with penny stocks. Oh, they're only a penny, so let's go buy 10.
Oh, that's exactly what people do.
Options are cheap and spreads are cheap. And the reason we use them is so we can participate in the trade and not put a lot of money in them, and save our money to put in other trades. So we have more chances to win versus one big chance. And there's a lot of choices out there. So you only want, like I said, 50% batting average. You don't want half the time going, okay, if I lose this, I lose big. And it's all about being greedy and blind by the reward. Sometimes I don't even look at the reward of the trade. I just look at the risk and go with it. And that's exactly the point of options and spread trading, is how much risk do you want to keep it versus the reward. It's not about, when people talk about spreads, oh, you can make this, you can make that. Okay, that's not why I'm doing the spread. What is the risk? Why stop talking about how much you can make? So you start off low, but then start getting realistic. Okay, it's $10, but I'm way out of the money. What's the real, I need to be closer to the money. So
we've said it time and time again, and I'm going to continue saying it because it was one of the hardest lessons for me to learn. But after I learned it, I seem to lose less money and I seem to make more money. Is the first goal is to become risk-free. Don't worry about trying to get to that profit.
That's it. Break even first.
Break even and lock in that break even. And now take the capital that you just got back and go find other trades.
Yep.
So now you have a free trade that can make money and now you have your capital back to put somewhere else. And you keep doing that, and you can basically use the same, $1,000 or whatever you put in that trade, and you can use it to build out 5 or 6 trades as you keep pulling the risk out of them. And before you know it, you've now multiplied your money and what you can make on it. And every time you do it and make it risk-free, why not do that? Why keep trying to swing for the fence when you can, take the baseball strategy of trying to get on base. Just keep getting on base and you'll end up scoring more runs. Don't try to swing for the fence every time to get that one home run.
Yeah, you got to get out of the gambler mentality.
I think you just made an argument for bunting.
I did just make an argument for bunting. Get on base.
Get on base.
And also sometimes you bunt knowing that you're going to get thrown out, but you might be able to help that guy get home.
If you can get on second, if that bunt, you can sacrifice that. Yep.
Who's on first?
What's on second? That's a good place to call it a day.
Yeah.
Who's on first? What's on second?
All right, guys. I always enjoy having both of you guys on. Master technician, master data maker over here. So just the two of you together, and I'm always just like, man, I need to go look at this now. So definitely appreciate having you guys on. Guys out in the chat, thank Coach Gino and Noah for being here today. We will see you guys next week. We're out.
Thanks. Have a good one.